If you ask me, hey, today, where should my portfolio be if I want to grow wealth and I want to be able to sleep at night? Cash. Sitting on cash and waiting for that fat pitch. Wait for a bottom. There will be bottoms that'll form. Bottom comes, test it, small position, no trust, tight stops, wait for a follow-through day. That comes, same deal. If you get stopped out, you're back in cash, you wait for the fat pitch. So that's our view on it.
I'm not sure if that's a sneak preview for our best idea for Matt later or not, so we'll have to see. So one question that's been consistent that we've been getting is just protecting portfolios, and that could be in terms of against inflation, against rising rates, against equity drawdowns. And there are really many different ways that you can go about protecting portfolios beyond just high quality fixed income, which hasn't worked this year. One could also use option strategies, trend following strategies, and there really are a number of other approaches. And so just in preparing for this call, I was looking through KRISHNA's ETF, and I saw positions in gold and some defensive currencies. So I just wanted to ask you, how do you go about choosing which defensive strategies to allocate to and how to size them?
Great question. So I think, look, if you think about it big picture, right, most of us are kind of in the similar boat, which is we've had a period of very low inflation, so our portfolio has been in fixed income-like instruments. So whether it's outright fixed income or tech stocks or Bitcoin or whatever it is, it's all long-duration assets which do well when interest rates are super low, right? As soon as rates start to go up, all these things go down. So that's the first thing. So bonds have gone from risk-free assets to become return-free assets, right? So that's the first thing you need to fix. The second problem you have is if you look at how much the US equity market has outperformed the rest of the world, it's just ginormous. We've never had a period where US equities have outperformed the rest of the world. And that's got to do with the composition of the index, margins expanding tremendously for 5-6 companies, all kinds of reasons as to why that has happened. But what that has made us is we've all become overexposed to US equities. Not just us, but even overseas, people are massively long US equities. The third problem we have in the portfolio is that we're all overweight of dollars. People have way too much of dollar assets, right? Now, dollar assets are great when you have a period like now where there was a lot of stress and the dollar goes bad and so on. But if we now look ahead and see what happens when the Fed starts tightening rates and inflation starts to come down and growth starts to come down, you're going to want to look at countries or places where there's disinflation, right? So the first place that comes to mind is Japan. I mean, after doing all the stimulus and everything, they still have disinflation because they have an aging population. So the Japanese yen is a good place to keep some of your money. The other place is the Swiss franc, because the Swiss are always fighters of inflation. They're like the old Deutschmark. They're very Germanic in the way they think about inflation. So Swiss francs is another place that's a safe place to park some of your money. And then the third one, of course, is gold. So what we said was we have a 60-40 benchmark we're trying to beat, but the 40% doesn't have to be in dollar assets. So we hung out in Chinese bonds because they were yielding more, but once the Chinese bonds converged to US treasuries, we said there's no point in being in Chinese bonds, so we'd rather be in Swiss francs and the Japanese yen. So we think thinking about your portfolio from these three constructs, which is being massively overweight of US equities, being way too long of dollars, and thinking about fixed income differently is what's going to be important in the next 3-6 months.
All right, thank you. So Andrew, I wanted to bring you into the conversation at this point. We talked about just how high quality bonds haven't given you the diversification benefit. And one of the places where investors often look towards diversification is in the alternative space and often towards managed futures strategies. So I wanted to get your thoughts on managed futures in the current environment. I imagine we've had this sustained trend, and albeit a downward one, that's probably benefited managed futures approaches. But how do you think they're positioned today? What happens if we no longer are in a trending market and you start to get more volatility around returns?
Sure, thank you. So just to take a step back. So what managed futures funds do, basically, is they're quantitatively based funds that, by and large, are looking for trends in the market. They are, right now, literally like pigs in mud. They love environments like this. 2000 through 2002 went up 40%. 2008 went up 20%. This year we're up 22%, 23%. The whole space is up 20%. The argument that I made is that people are going to give you lots of very precise views as what they think the world is going to look like over the next 5 or 10 years. Literally nobody knows. Okay, and the facts and the information that we get is going to change a lot. I think it's fair to say that we are probably in a big multi-year regime shift around fixed income. Rates are probably, if inflation stays where it is, rates are going to have to go up, or if it comes back down a lot, maybe rates won't go down a lot. But again, the lesson over the past several years is the consensus has been consistently wrong. When that happens, it actually creates a lot of trading opportunities that are outside of 60-40. Personally, I agree that we went through an extraordinary, ridiculous decade for U.S. equities and bonds in particular, so we could be facing a lost decade for 60-40 portfolios. That's pushing people to look out beyond it. Managed futures is an active strategy, but it's something that you can basically put in as a 5 or 10% allocation to portfolio, and in a year like this, where fixed income has gone down a lot more than anybody expected, to have a portion of your portfolio that's up a lot, really gets you closer to having a glide path for your client portfolios. So I spend a lot of time trying to demystify it because it is a complicated space. It is something that people often talk about in very complicated terms. And again, I'm happy to have conversations. It's a little hard to do on a panel like this, but I think we've often said that managed futures, if you're looking to take risk out of a 60-40 portfolio, it's probably where you get the most diversification bang for the buck.
Right, so this next question is admittedly a selfish one. So I've been analyzing ETFs for about 15 years now, and what you notice is that for very seemingly similar ETFs, you can get very big differences in the portfolio and the risk-return characteristics based on the decisions made when constructing the product. So, for those who are looking to incorporate managed futures and evaluating strategies, what should they focus on?
So, managed futures are very different than. The point that you're making is basically if you pick 3 different managed futures funds, they can look. One could be up 20, one could be flat, and one could be down 20 the same year.
Yeah. And I think we've seen that year to date. Right?
Yeah, you've seen that, right? I mean, I think there's probably a 40 or 50 point spread. We approach this from the perspective of, take a step back. I think there are 2 different kinds of investors in the ETF land. There are guys who are very, very tactical, very short term. We call them the gunslingers. Those are the guys who are, trying to basically buying different thematic ETFs and trying to make a lot of money doing that. There's another camp over here that are guys who build long-term asset allocation models who are thinking about how do I take the Sharpe ratio of my portfolio from 0.4 to 0.42 and do it in a very efficient way. Those are the guys that we focus on. And for those guys, they don't want to have to worry about whether they're going to be in the guy who's up 40 this year or the guy who's flat, or the guy. So we, as a strategy, try to build things that are very, very index-like in that we try to diversify across lots of different managers and then provide that in a client-friendly package. We're kind of unique in the space. Everybody else who's going to come to you and talk about the space, with the exception of friends of mine who run one fund on the mutual fund side, but in the ETF world, it's always the problem of, I like the space, but it's almost the equivalent of, we've used the analogy if you say, I feel really good about value stocks today, and then you say, oh, and I found this small E&P company in Oklahoma, and we're going to buy that and make it a 5% allocation of the portfolio. Like, literally nobody does that. But in the alternative space, that's what people do all the time. They say, I want equity long short, and they give it to Bob. Well, Bob can be down 20% this year when everybody else is up 10. So managing single manager risk is probably the most underlooked but most important area when thinking about things in the hedge fund space. And so you've got to have a strategy for dealing with that.
Right, so I never thought I'd say this, but to follow up on a gunslinger reference, you mentioned thematics. So just let's bring in Matt and Bruce here, since you're both involved in the thematic ETF space. So thematic ETFs had been a darling of the ETF space a couple years ago, but they've really suffered during the recent correction. probably a good reason is like a lot of them have a SMID orientation, SMID growth orientations, right? And growth is lag, so it's really hit the thematic space hard. So, I was wondering if you guys could share your thoughts on the thematic ETF space at this time and going forward. And so let's start with you, Matt.
Yeah, so I think unfortunately a lot of the thematic stuff that we've seen come out, over the past couple of years is more marketing gimmick than real, investment thesis. But understand we're coming at it a little bit differently. My clients are not financial advisors. A lot of financial advisors can't even buy our products, and they don't fit nicely at all into traditional asset allocation portfolios. But what we believe is we've got to kind of morph out of thematic stuff into more tools that people can use that aren't necessarily based on whatever the gimmick of the day happens to be or the hot thing of the day happens to be, but things that people can use for the long term. They can move in, they can move out of them, but that offer them different exposures than kind of the stuff that's out there.
Bruce?
Yeah, it's funny, you look at, kind of the evolution of what's happened in the ETF space over the last, 12, 15 years, and, thematics, have taken off in the last 5 or 6 years, and you're right, David. You look at maybe 3 or 4 years ago, you had great performance, and even last year you had some that 2020 and 21 had great performance. Some had more press than others, and Matt, I think Matt has a solution for that one. I like that one. But if you look at the thematic space, today, I think it's about 400 funds, and it's about 75 billion, but it still represents only about 3% of the entire ETF space. So I think there's a lot. I think we're coming to a point in the funnel where I agree with Matt. I think if you look across the space, I think there are some thematic ETFs that were built on a solid investment premise, and some that were not. So I think we're getting to that point in the funnel, whether it's up or down, and I think we're going to start to see kind of a narrowing of maybe the number of issuers that get into the ETF space, but those that do get into the thematic space are going to be more focused and delivered, I think, on true investment process.
Okay, thanks. And on the related side of the equation, right, and where you have thematics often leaning towards growth, you guys also have, right, the cash cow series that's predominantly value oriented. I know at UBS right now we still have a tactical preference for large cap value. So, we've seen sharp outperformance from value during this correction. Again, no one cares because of the whole absolute and it's relative. But so, what are your thoughts on sort of values outperformance and prospects?
It's funny, we've had a couple head fakes in the last couple of years with our cash cow series. We're very fortunate right now. We're in the right place at the right time. Over the last year, we've gone 5x as far as asset growth. Just the beginning of last year, the large cap fund was at just over $1 billion, and today we're just over $5 billion. And we think we've uncovered something different in the value space today. If you go, so to answer your question, David, I think the value paradigm has turned, and I think it's going to be here for a while. And I'm not going to get into the inflation and the recession and what's going to happen. Although I think we got a wake up call yesterday with some of the consumer names, and again Kohl's this morning, and the fact that we had Jerome Powell basically come out and admit that they made a mistake and they should have started raising rates a couple of years ago. So I think the Fed is I think they're in a position where they are now forced to continue this mandate. So I think from a value growth standpoint and however you want to look at the market, I think we're going to continue. I think we're going to continue with this value paradigm. And it's funny, we've done a lot of work over the last couple of years at looking at this space. So if you go from 1926 to 2021, there are 16 periods where value has outperformed, pretty well over growth, and those value periods last for about 39 months. So I think we're just in the beginning stages of this value area, and a couple other different things that we have uncovered is the fact that you look at the way that most managers look at value, right? So predominantly, if you look at all the index providers, they're using price. And if you look at price to book over the last, if you go from, I think it's 1969 to 1990, if you look at the bottom 20% or the cheapest 20% stocks compared to the 20 most expensive stocks on a price to book value, from that period you had a return premium of about 7%. There were a couple guys out of Chicago that got pretty famous that identified the value premium. So back then it worked. Now, if you go from 1990 to 2021, you look at that same metric with regard to the cheapest 20 stocks to the 20% most expensive stocks based on price to book value, there is about a 1% return on premium. So we do things a little differently. We don't use price to book. We use free cash flow yield, which if you look at all the metrics out there, we did a lot of work. We studied. We worked with our friends very closely at FTSE Russell. They help us, with a lot of data, but we're able to look at, again, what is the best factor when you're creating, a true value fund. What is the best factor? So you look at price to earnings, price to book, price to sales. You look at other metrics, but then when you look at free cash flow yield, you look at that has the best performance and the fewest 12-month negative drawdown period. So again, we right now we happen to be in the right place at the right time, and we just hit our 5-year number. Everybody talks about the 3-year number, but the 5-year number is even better. So we hit the 5-year number in December, and on a 1, 3, and 5-year basis, we are 600 basis points above the benchmark over the Russell 1 value. So again, we're lucky and fortunate to be in the right place at the right time.
All right, thank you. So I wanted to spend some time on innovation, and with the ETFs, innovation has been constant over the years. And last year, I think we had over 400 ETFs issued, so there's constant just new strategies coming to market within the ETF wrapper, and just you're seeing more and more unique strategies that are available and can really help clients managing the exposures in the portfolio. So I wanted to give everyone on the panel there a chance just to talk about product innovation, what they're working on or what they're seeing. Let's start with you, Matthew.
Sure. So where we see innovation coming is, not on asset classes or sectors. I mean, there's enough stuff out there to slice and dice that stuff. We really see it, like I said before, in tools that people can use. So, one area, for example, is the inverse space when you're looking to hedge. Historically, and I mean, I've been trading for a long, long time. I've used inverse ETFs. When you're looking at inverse ETFs, you basically got inverse S&P or inverse the Qs. And, if you time something like that right, great. But the problem that I've always had with that stuff, if you're inverse SPY or inverse the Qs, what are you shorting? You're shorting FANG. You're shorting Apple, Microsoft, Google. That's not a recipe to get rich. That's not a long-term type of strategy. So, innovation in the inverse space, to me, is about, finding exposures that can do well even when the market's going up. So, for example, what we did, we launched an inverse ETF on de-SPACs. De-SPACs are companies that come public through SPAC mergers, and a lot of this stuff is the crappiest of the crap. And I mean, you know, that stuff, you know, it's a portfolio of 25 stocks, and I can tell you probably at some point a chunk of them are going to be bankrupt. So, I mean, that's stuff that can do well regardless of what the market's doing. We did an inverse ETF, the first ever inverse ETF based on another ETF that, you know, again, is something that the market could be going up, but that ETF could be going down. And then we just launched inverse KWEB. You know, just, you know, to me, there's so much stuff going on in China, you know, beyond the zero COVID policy that, you know, that's something that we think could be a good exposure. The other thing that we're excited about, and excited really to see how it works, because I think it's an idea that could be massive or it could be a complete and total dud, and I have no idea which it's going to be, is single stocks. So we were the first to file for a series of 2x long and short on individual equities. You know, in my mind, again, we're dealing with the retail investor. Retail investors like leverage. They like to short stuff. So, you know, typically if I want leverage on Tesla, I'm either, you know, using margin, which I can't do in an IRA and which has issues associated with it, or I'm doing options, which has issues associated with it. If I want to short something with leverage, I'm using puts, which again has issues. So I really think that we could see an environment where all the major stocks have 2x long and short ETFs on them, and that could be a pretty robust solution, or it could turn into nothing, but we're going to find out. So, you know, it's really tools that investors can use where we see the future of innovation.
So I'll say for the record, I'm a huge believer in innovation. I think what's happened in finance, I've written a lot about democratization of investing. We are the most boring when it comes to innovation. In 15 years, we've only done 3 products. I won't do products unless I'm sure they're going to work. All 3 of our products are well into the top decile of their categories. We're also known for what we don't do. And so I'm sort of the pain in the ass who has loudly proclaimed when all sorts of hedge fund products that people brought into mutual funds and into the ETF world, I was the guy who wrote stuff saying why it wouldn't work. And so our philosophy is very different. If you're going to invest with us, you're going to have our fund in 5 years or 10 years. And because we're only going to launch it if we know it's going to work. So the structure on innovation, the way we did it in ETFs is because the legacy of people who've launched hedge fund products in ETFs is in general the products have been terrible. And so the whole space, you have an entire generation of people who grew up in a world where you have 60-40 portfolios and they never diversified beyond it, and it worked. Every year it worked. Rates went lower and the total return on fixed income was great. That helped to drive up equity prices. But we're in a different world right now. And so, you know, so the fun that I have in this job is I get to talk to guys who are on the investment side, trying to understand how they navigate what is really a completely different world over the next 5 or 10 years. And, you know, what I always say to them is, you know, I'll be incredibly clear to you about what we're trying to do, and I feel very, very confident, 80% or more confident that we're going to get that right, and then we can have a conversation whether it fits in your portfolio. So you won't be seeing much innovation from us on the product side.
I mean, I'll just add one thing. I mean, look, besides the thematic ETFs, there are 2 broad categories of innovation in ETFs, right? One is the leverage part of it, which Matt mentioned, but there's other things where people wrap like option structures into an ETF and kind of gives you an exposure to an OTC option that you otherwise couldn't yourself trade. So that's one. And the second one, I think, is we've created too many ETFs, right? So there's plenty of ETFs out there. Somebody has to decide which ones to own at what point in time, right? So our attempt at this asset allocation ETF and other things we're thinking about is just do that, right? Because imagine you're long Andrew's managed futures ETF. Now, it's done extremely well over a period of time, and it's a long-term hold. But imagine there was something else you were long, and it's done pretty well, something that's hedging interest rates going up, right? You'd have to decide when to sell that, right, and to get into something else. So I think that is something, it's like kind of a meta layer on ETFs, but I think that's where I think more innovation can be done because, ETFs, as you all know, is a very tax efficient product. So if you are doing this rebalancing within the ETF, let's take 60/40 that Andrew mentioned. 60/40 is annualized about 10% over the last 2 decades. I mean, can you think of a strategy that's that can do that over the next 2 decades? Probably hard to see that. But I think like if you take 60/40 and then do that rebalancing within an ETF in a tax efficient way, you're adding another couple hundred basis points on top of that, right? So I think that is what is appealing to me is like people are going to start looking at taking ETFs and kind of putting portfolios together and rebalancing because somebody has to decide when to sell SARK and buy TARK, right? So that's going to be the interesting part, I think.
All right, Bruce?
Yeah, so just, innovation. I just wanted to go back to thematics for a second. I think we'll continue to see innovation on the thematic side, but just, making people aware and understand to make sure what they're buying, right? So the knock on thematics is that when they come to the market, like the good performance is gone already, right? So I think there's a stat out there that says that all new thematics ETFs last for about 5 years. And then there's about a 30% risk-adjusted return loss based on those funds. So the newness, the theme has kind of already started to wear out. So again, just be careful, and it's so important when you're looking at the thematics and you understand index construction. So a lot of these thematics hold maybe 20, 30 holdings, and they may or may not be mature companies. So if you're looking to invest in thematics, you want to make sure that you go to the index construction and make sure that the index construction is as pure exposure to that industry or to that theme that you can get. We right now we had 3. I'll call it thematics. We had a real estate fund. We had 2 real estate funds. We had a data center one and an industrial real estate, and then we launched one in the pandemic, the Pacer Bio threat, which was I'll admit, was kind of a knee-jerk reaction to launching a product in the pandemic, and it was consumer staples, and it was Zoom, and it was Clorox, and all those names. So it was a knee-jerk reaction. But we're going through the process right now of launching 2, and we just sat down yesterday and we're just finalizing the index methodology, and we're just making sure that that these companies are actually directly tied from a revenue standpoint. So you want to make sure that you're looking for companies that are growing. Profit growing, and that your index construction is almost 90 to 100% pure. When we were doing the index review on some of the competitors, you would see that the index is probably 60%, 70% pure, and then there are other companies that maybe are 1 or 2 standard deviations away from what that theme really is. So again, just when we were talking about thematics, I wanted to bring that up to make sure people are really looking under the hood when they invest.
Yeah, I'd echo those comments. You do want to pay attention to how a theme is defined because there's no standard classification system when you're dealing with themes. So seeing how it's defined, the thresholds for inclusion, and looking at the companies making up the portfolio is really important. So it is a best ideas panel, so I feel like we have to end with our best ideas. As someone that first decided to dabble in crypto about a year ago, I'll spare you my best ideas and leave it to the experts on the panel. So let's go in the opposite order, and we'll start with Bruce and just come down the line.
Best ideas. I guess back to what I was talking about before in your question to me. Again, investing in this environment, rising rates, inflation, and who knows what else and how long that'll last. But whatever you're doing, again, looking for, healthy companies with healthy balance sheets, making sure that they can survive in this environment. Outside of that, I like the materials space. I think there's we're like I said, we're going to launch something soon, but I'm a big believer in what's going on out there with electric and AI and the Internet of Things. And I'll even throw out there's a DMAT as a ticker on one of our competitors, and it's disruptive materials. So if you look at all the materials, if you look at all the materials out there, they're going to be necessary to drive this innovation. I think that's going to be one space to look at.
Yeah, so I'll say two things. One is that in terms of the equity market, we kind of prefer countries where the policies are friendly. So if you look at China or Korea or even Japan, they're still fighting disinflation. China didn't do any stimulus during the whole COVID pandemic. Korea's similar situation, and valuations are super cheap. So you look at the equity market trades at like 8 or 9 times. Japan, same thing. So Korea is again another market that's super cheap, and the currencies of these countries are also extremely cheap, right? So when you think about as a dollar investor, you not only care about the equity market performance, but also the dollar returns. So I think on a dollar return basis, those things look super attractive, right? And we don't like certain other countries like Turkey and so on, but those three are our picks on the equity side. Now on fixed income, I think we've gotten enough in the front end. So the Fed's fully priced in. They're going to go a couple of 50 basis points and then a couple of 25 basis points and so on. So like the front end is sort of attractive in the US. So what we prefer instead of buying the front end is selling puts on, the treasuries so that if yields go further up, we get long because the volatility in that market is still pretty high. So we prefer US front end and not the long end. And then finally, I think, you have to think about the dollar because the dollar is very expensive at the moment. So if you have like a 10, 15% move in the dollar, of course, you wouldn't see it in your portfolios because they're all showing up, in dollars, but it will be a meaningful impact from a return perspective. So that's something to think about. And we think the dollar is already peaked. So.
Well, when you're a one-trick pony, you don't have a lot of best ideas.
You have 3 different ETFs.
What's that?
You got 3 tricks.
I got 2 ETFs. So one of them I like, one of them I like not as much. So I'll tell you, I think it's blindingly obvious if you're looking at if you're a portfolio allocator and you're trying to find ways to add excess returns and reduce risk in a portfolio, you should have managed futures. There are a handful of guys who do it in the ETF space. I obviously think that we do it better than other people do it, but I think you're just going to hear a lot about the space, and it's just because, I could be wrong. We may not be in a regime shift by 2023. We might be back in low rates. The Fed's cut rates. There's no war in Ukraine. Lockdowns have ended. COVID's gone forever, and we're all back to business. I don't think that's going to be the case. And so, what managed futures tends to do is it works in environments like right now. And I wrote a paper on inflation back in the beginning of 2021. I basically said, look, a lot of hedge funds that I talk to think inflation's going to come back. And that's a huge problem for fixed income portfolios, and it could go on for years and years and years. I think since then, fixed income's down 15%, and my recommendation was managed futures would actually be a good fixed income hedge. So the best idea that I've told people is the simple thing is you take 10% of your portfolio that was in fixed income, and you move it into managed futures, and you probably do better over the next 5 years.
All right. So first, understand where I'm coming from. I'm not a long-term investor, and I would argue that most people who say they're long-term investors in a bear market are either lying to themselves or just afraid to make paper losses real, or unrealized losses realized losses. We're known, obviously, we've got a lot of stuff, but we're known for our inverse ETFs, SARK in particular. But when I look at kind of my best idea right at the moment, again, I'll go back, it's cash. I think this is a very difficult market today to go short, and I think it's a nearly impossible market to go long. What I do think, and again, I mean, no one can predict squat, but what I do think is the market's ridiculously oversold. It's due for some sort of bounce, and then another leg down. And if we do get some sort of bounce, it will probably benefit the ARC names a lot, and I think that'll be a great opportunity to buy, SARC or other inverse ETFs. But if you ask me for my best idea right at the moment, again, it's cash.
All right, thank you. So we'd just like to open it to any questions that we have in the audience. Yes.
We're an alternative fund. We launched about a year ago, so we're running a passive, rules-based, quantitative long-short strategy in the S&P 500. But since we fall into that alt category, and we share what Matt was saying about growing wealth, but being able to sleep well, and Bruce trend following. But how do you guys handle the challenge of the apprehension that you see out there in the market when talking to RIAs, particularly, that are maybe less sophisticated or less versed in the alt space? So what are you guys using? How are you getting through to those people?
Whoever.
Yeah, so look, it's education. I mean, so I work with a former math professor who solved 70-year-old math problems. I work with another guy who's an incredibly capable quant. I'm not a quant. Like, I literally, I'm like the only managed futures guy who is like, I need to be able to put it on a napkin and be able to explain it to people. So we host a lot of webinars. We talk to people about it. It's the problem with hedge fund strategies is people spend decades selling complexity. It's not that complicated, what they do. But 99% of the people who invest in hedge funds want their clients to believe that these are magical, mysterious, money-spinning machines. And I'm kind of the guy who's like, no, we've got a robot dog, but it is a really, really good, reliable robot dog. It happens to do better than your hand-picked stable of greyhounds, and that drives people completely crazy. And so, that ethos of simplicity, being able to see what they're invested in, was very challenging for us for a long time. We're called either the vanguard of hedge funds, or some people have, it's a ridiculous comparison, they call me the John Bogle of hedge funds, because our view is that, again, it's not that mysterious, and so, but it does require a lot of education. Managed futures was like the least popular hedge fund strategy by 2019 or 2020, and so, but there's a lot of work. People are coming back into it now. On the mutual fund side, there's been billions of dollars of inflows this year, and we do this in 2 years, and everybody in this room will have exposure to managed futures in some capacity.
I agree on the education side. It's getting the advisor and the investor to understand what they're buying and why they're buying it, and where does it belong in the portfolio. We have so many discussions about implementation. The worst thing that we can do from a sales practice standpoint is deliver a great idea and a great solution and not tell the advisor where it fits within his portfolio and what's it going to do for him or her and what's it going to ultimately do for the investor. I mean, we started with trend following back in 2015. That's how we got into the ETF space. And we learned some lessons along the way. And as you know, with trend following, sometimes it works and sometimes it works better. So 2018, we did really well. 2020, we were just about to lock in a 5% loss versus the market of about 25, and on one day we have a 5-day confirmation, and the market went up 10%. So at the end of the period, we were down 19, the market was down 37. But again, it's education, and it's funny. I was with some advisors last week, and they were talking about they own our Trend Pilot series, and they're like, we don't talk about 60/40, we don't talk about asset allocation, we don't talk about, all we talk about is goals-based investing. So we talk about what are your goals, and then when the client calls, we can say, I have a piece in your portfolio that addresses the risk that's going on in the marketplace today. So they don't have to talk about what specifically the product is or what it does, but the advisor knows that they have an answer for the investor.
Thanks. Any other questions? Could see the look of thirst on everyone's faces, so I guess we'll wrap it up. Thanks to the panel. Great job.